Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi, good everyone. How are you going? Thanks for joining us on the podcast today as we navigate property in a COVID environment. And you'd have to be living under a rock somewhere if you didn't hear the news coming out of the Federal Treasurer just a matter of days ago around Australia formally being in a recession. And for those of you who did your high school economics or business studies, you'll know references two quarters of negative GDP. So essentially, the March quarter, when those numbers come out, it was negative about 0.6% GDP, and the numbers for June quarter, so up until the 30th of June, have come out, and the national accounts have come out, and it's telling us that we fell by sort of 7%. So annualized, it's the high sixes of negative growth, and it's not a good story for Australia. To give some context to how we're performing compared to our sort of compatriots in the other Western world, you think about the UK or Germany or France or even the US, we're doing much better. They've posted much bigger drops in GDP, but that doesn't discount the fact that this is the worst performance we've had since or even prior to the Great Depression. So the economic landscape is not great for Australia, but we're doing better than most. I'd like to think that the government is doing all that it can to make sure it's stimulating growth, economic activity, and how that sort of trickles right down through to all parts of the economy, and particularly for property investors, macro, micro housing markets. It's not my specialization, but I do know someone pretty well who is pretty good at this sort of stuff. He's been doing it for about 20 years. Tim Lawless, he's the head of research at CoreLogic, Asia Pacific. He's in the studio. We're going to chat about all this sort of stuff. I know they've just delivered their August numbers for house price values. We'll get stuck into that. Changes of activity and transaction in real estate, we'll get into that. And also touch on some migration, which is a big driver of rental demand, but also prices moving forward. Tim, how are you going?
I'm really well, Phil. Thanks for inviting me on the podcast.
It's good. So I know a lot of people that travel a lot, myself included, but back in the day before COVID, I think you even traveled more than me. How's life in inverted commas lockdown treating you? So you're not getting on a plane. Is it changed things for you, mate?
First of all, I think it's interesting we're calling pre-COVID back in the day already.
I know.
Things changed that much, haven't they? But yeah, I think personally, I haven't been on a plane since early March, which has been great. I haven't had to put a suit on above the waist or below the waist anyway since then either, really, because we've been doing all our engagements via technology like Zoom as well. So I think it's really proven up that the productivity benefit you can get utilizing technology highlights this great experiment of working from home seems to be pretty positive for a lot of people who can actually pull it off. Generally, they're knowledge workers or clerical workers or office workers. I think we might be on the cusp of something new here that starts to see more and more people doing this more permanently.
Well, no doubt, being this is a term of endearment, a property data nerd, you're already thinking about how this is going to shape house values moving forward. This is a wholesale shift in how people are living their lives, and that's going to shape behaviour and habits, and therefore where people choose to locate themselves. You're up in sort of the Noosa part of the world. Are you already seeing changes up there? It's a pretty attractive place to be now because you don't need to be locked to or wed to an office anymore.
Yeah, that's right. We are seeing very vibrant market conditions across the Sunshine Coast. We're hearing from local real estate agents. They're reporting record months up here for the number and the value of home sales, some pretty big ticket homes moving under contract as well. So, and it's not just the sunny coast. We are hearing these stories. We can see it in our data as well across a lot of the regional centres outside of the metro areas, be it the Gold Coast or Newcastle, Wollongong, some of the wine regions, any of the markets that are still within commuting distance of the major working centres like CBDs, but also offer up some lifestyle opportunities, quite often cheaper price points as well, seem to be quite popular. And I think this is something that's one of maybe the silver linings of COVID is that people are finding out that they can work remotely, that they can do it really well and effectively, and their productivity may be even better than what it was pre-COVID. And I think this is going to be one of the legacies that we're living with post-COVID as well, is we do see more and more people working remotely and looking at these either regional markets or potentially even the outer fringes of the capital cities that tend to be much more affordable. But we've always had a bit of an obstacle there in terms of demands based on either commuting times or other factors that made living in the outer fringes not quite as desirable as being closer to the major transport hubs or working nodes.
How significant, Tim, is this shift? Is it a seismic shift? So all those things which have, and we're here to talk about property price values, particularly for investors, but all of those drivers which has dictated or determined the positive or negative, but I'll talk about the positive increase in prices. Is that all gone now? Is that all now back in the day? Is there new rules to how property is going to perform in terms of capital value moving forward because of COVID?
Well, I think at the end of the day, what determines a property's performance is supply and demand. So nothing's changed there. The supply and demand dynamic absolutely is changing though. So I think simply understanding where is demand going to be coming from has become really important. Which are the areas around the country that may be undersupplied or oversupplied as well. So a few extreme examples there. If you look at some of the inner city markets of Melbourne or Sydney, these are classic markets where supply levels are quite high. Even pre-COVID, we'd seen many years of significant influx of new supply into these markets, particularly high-rise apartments. And now we've also seen a major impact to demand as net overseas migration has pretty much just stopped. And a big component of demand, or at least rental demand in those inner city markets, has been overseas students, visitors, travellers, as well as locals or domestic students who are now generally studying from home, or hospitality workers who have been one of the hardest hit industries around the country. So these inner city areas have had an impact on both the supply side and the demand side. Whereas at the other end of the spectrum, you've got many of the, these key regional markets where supply has generally been quite constrained. They've not been impacted anywhere near as much by overseas migration stopping. In fact, last year, about 85% of overseas migrants, they flowed into the capital cities, and about 75% of that 85% went to Melbourne and Sydney. So it's really clear that some markets are going to be impacted much more by that stalling out of migration, whereas other markets will be quite insulated from it, but also benefit from more internal migration trends.
So as a property investor, which I am, and the lion's share of our listeners are, how much should you be changing, maybe not necessarily the strategy, but the tactics in how you invest, considering COVID and the way in which populations may evolve over time? No one knows what's happening with the virus or when there will be a vaccine available, and then when migration will kickstart again into Australia. And that's always been a driver of economic activity and also property price growth. But how much should you be rethinking what you're doing right now based on these changing dynamics of detethering people potentially away from CBDs?
Yeah, I think it's really early days at the moment. So anything that we're, making decisions on now based on the fact that, say, overseas migration has stopped, that's not going to be forever. In fact, we will start to see, say, foreign students potentially arriving earlier than the international borders open. It looks like a lot of the state governments are trying to bring foreign students back in under a quarantining regime, rightly or wrongly. But if we do start to see that gathering pace, then maybe that's going to start to shore up some of the inner city apartment demand a little bit better than it is at the moment. So it is a little bit speculative that some of the changes we've seen early through COVID are going to be permanent. Still, even though a lot of people are working remotely, who's to say a lot of employers won't actually prefer their staff to be working from the office? So I think we need to see a little bit more permanency in these trends before we're making a lot of decisions. But of course, investment often is around risk-taking and speculation as well. So those people that pick the trends really early are always going to be at the front of the queue. Outside of those sort of trends, we're also seeing some of the markets that have been your underperformers over the past 5 to 10 years are now becoming probably the markets that are starting to become more interesting. Perth is probably one of the best examples here, where if you're buying into the Perth market now, you're paying prices that you were back in 2006. That's how far values have fallen, that they're down about 22% from their 2014 peak. And that's an economy that seems to be bucking the trend of weakness. Even before COVID-19, we were seeing state final demand in WA was ramping up Most other areas around the country were scaling down. We've seen a lot of state-based investment in infrastructure as well, outside of the mining sector. In transport particularly, is really driving that economy, and it's super affordable. The rental markets are tightening over there as well. So it looks like some of those markets that have previously been maybe a little bit on the nose, not very popular with investors, might start to be worthy of consideration now. Whereas you look at some of the areas that were most popular with investors, cast your mind back to, say, 2015, about 60% of demand coming into Sydney was investment related. That's now dropped down to around 30%, which is still higher than the national average. But it really highlights there was quite a herd mentality moving into the Sydney market. And I think people that start to pick the new trends of where the new investment hotspots are going to be earlier than others are going to be in a fortunate position. So I think Perth is definitely one to watch. Markets like Southeast Queensland also have been, not really all that popular with investors, but seem to be treading a path or a trajectory now that's healthier and at least more resilient to falls than what we're seeing in the main capitals.
So to your point there around those investors which spot the trends earliest will probably get the greatest value out of it. Now, we're here to talk about data, and we'll get into sort of performance around the capital cities in a moment. But the philosophy, Tim, of does data tell the story of what's already happened, or does data help you spot what those trends are going to be? So what I'm getting at there is that how do we use what you do to identify where those new trends might be emerging, or you've already missed it if it's already appearing in the data?
Yeah, so a big part of using data to make the strategic decisions is in looking at where the trend is taking the data, right? So you're absolutely right. Generally, most of the market measurements are backwards looking. And of course, there's going to be forecasts in a marketplace. Inevitably, a forecast is always going to be wrong, right? It's never going to be exactly right. It's based on a mathematical model, and you try to make a lot of assumptions to predict where the market's going to go. Those assumptions and those forecasts, of course, are all based on data sets. The first piece of advice I'd say on how to use data to make an informed and strategic decision is shop around, right? There's no one source of truth or one source of one-stop shop. For example, if you're looking at housing market trends, certainly suggest using CoreLogic data, but you need to blend that with demographic data. You need to blend it with the economic data. What's happening with government investment? What's happening with different policies across the states as well? So you really need to be looking at a whole variety of different data sets to get a view on where the market's going to be going from here. At the end of the day, you need to make a decision. You can analyze the data as much as you can. A lot of people get paralyzed by that. But at the end of the day, you need to make a decision and put your money down on a particular investment. And sometimes that's harder than other times in the market. Now, arguably, there's so much uncertainty in this marketplace based on the virus, based on the different amounts of stimulus that's out there. It's much harder to know where the market's going to go. But I think for anybody that wants to buy into the marketplace now, the one thing that is sure, that you can be sure of, is that interest rates are going to stay extremely low for a long period of time. And that cost of debt has never been this low. And I think that helps to shore up some of the risk that is certainly we're seeing in the market.
Yeah, the RBA, Reserve Bank of Australia governor, when he made his first Tuesday of every month is when they do the interest rate announcement, and they've kept it consistent at 0.25%. He indicated in his commentary around it that he does not see prices or interest rates moving for the next sort of 3 years or so, right? We're in a period of time with really low interest rates. It comes down to, as a property investor, how you capitalize on that. And I think back to sort of a couple of years after the GFC, and people ask me all the time, Tim, what do you think your biggest mistake in property is? And I'll always say, I wish I bought a lot more property at that period of time from like 2010 to 2013 in Sydney, because I could have, but I didn't. Do you think people are going to be saying the same thing around COVID-19 at a point in time, saying, geez, I wish I bought a lot more property at that point in time? It's always the way it happens, right?
Yeah, absolutely. I'm sure that that'll be the case. I mean, you always look back at the low points in the marketplace in which you bought at that time, be it in property or be it the equities market, whatever. That's obviously a luxury of having the benefit of time to know what happened. There's probably equally as many times where somebody's tried to pick the bottom of the market and has kept on going down, right? So trying to pick the bottom of the market is in many ways a mug's game. It is very difficult to do. I think the best thing about timing is just making sure the timing suits your own budgets, your own purchasing decisions, your own strategy. And generally, time tends to heal all wounds, right? So property is typically a long-term strategy for most investors. And over time, I think you'll find that even if we do see prices falling further from here, which I'm expecting they probably will, given, say, the next 5 to 10 years, stimulus is going to remain quite, I think, formidable, at least for the next 3 or 4 years. As the economy gets back on track, interest rates are going to stay low, and eventually population growth will start to ramp up again, if not from international sources, then across interstate boundaries, depending on which states are showing the best economic conditions. So I think there's always going to be opportunities out there. It's just figuring out where they're going to be.
So, Tim, let's go through the states and have a look at the August numbers. So here we are recording early September. We'll just go to a break beforehand. Back in a moment.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Tim Lawless, Head of Research, CoreLogic, Asia Pacific. We're chatting all things data. Tim, you've just released or made available your August numbers around price values. Any surprises? Let's go state by state because I know a lot of people will be wanting us to do that. We'll kick off. We'll go a nice clockwise direction around Australia. We'll kick off in your part of the world, the great state of Queensland. How's performance there in Brizzy?
Yeah, Brisbane's been a pretty stable market. Interestingly, if you look at the marketplace since the end of March, which is probably a good time frame to get a view on the post-COVID or the COVID period to date, we've seen Brisbane housing values have only fallen by 0.6%. So they're down 0.6% over that entire period. In August, they're only down 0.1%, so down 0.1% over the month. So very stable. We're seeing a little bit more weakness in the unit market than in the house market across Brisbane. And this has been the case for a number of years. Not that the inner city markets are oversupplied anymore. It seems to be a weaker performance coming out of the more outer fringe markets that have seen a lot of new unit developments around Ipswich or Logan. Seem to be the weaker unit markets dragging that broader headline number down. But I think overall, Southeast Queensland, including Brisbane, the Gold Coast, Sunshine Coast, even Toowoomba, seem to be weathering this COVID storm quite well. Very affordable markets, contain the virus pretty well so far at least. Border closures clearly aren't great, but it does seem to have kept the virus at bay.
And not to go too much into politics, but we talk about sort of macro and micro factors which shape property markets. The current government up in Queensland copping a little bit of flack, the Premier. What's the sort of collective view of Queenslanders around how the state government's handling things?
It's mixed. It's really mixed. As a Queenslander, you can understand the decisions to keep the border shut with New South Wales, but it's definitely aggravating a lot of people, particularly when you look at the very low number of virus cases emanating out of New South Wales and new virus cases. It doesn't seem to make a lot of sense. But then if you see what happened in Victoria, you kind of look back and say, oh, well, maybe that could have happened here. But I think you'll find the opinions are very mixed. If you get further south towards the border of New South Wales, there's a lot more animosity towards the government because it's made things very difficult trying to get...
Some kids can't go to school, right? They live in one state and go somewhere else, or healthcare. Anyway, outside the scope of this podcast. So let's go south into New South Wales and into Sydney. How's it performing?
Yeah, Sydney's also seen pretty mild conditions. So values are still falling. They're down about 0.5% in September. And through the COVID period so far, housing values in Sydney are down about 2.1%. So pretty mild conditions. Values haven't fallen anywhere near as much as Melbourne, but it is still a marketplace that's been quite volatile in terms of activity. So to give you some examples of that, as we moved through April, we saw listing numbers in Sydney and in Melbourne. They more than halved through that space of time. Transactional numbers fell by about 40%. But then through May, June and July, we saw the market bouncing back pretty quickly. And the last 3 months across Sydney have only seen sales, sort of 2% type thing lower than what it was in the same time a year ago. So the market seems to have normalized quite quickly. Auction clearance rates are holding around that decade average around about 63%. over the past few weeks and on growing numbers as well. So the number of auctions being held across Sydney has consistently been higher than a year ago. So it looks like that market is surprisingly quite resilient. So some mild falls in values, pretty good levels of activity, and the rate of decline has been easing off the last couple of months.
And I guess also it's, and you can talk to this, Tim, important to, we're talking about the aggregate of many different markets within Sydney or Melbourne or wherever it is. So, you do have negative price, gains, but is that driven by just a handful of markets pulling the aggregate down, or how does the numbers actually work? If you can give some insights into that.
Yeah, there's a lot of micro markets, obviously, in these numbers. One way to cut the data, for example, is to look at the different valuation cohorts. So to put that into some context, in the top quartile of the market, so the most expensive 25% of the market, we've seen Sydney housing values fall by about 3% since the end of March. So more significant than what we've seen across the broader market. But at the lower end of the market, the most affordable quarter, we've only seen housing values fall by 0.2%. So hardly anything, that they're virtually stable. And I think part of the explanation for this underperformance across the more expensive sector of the market is cyclical. We have seen that top end of the market or more expensive properties well and truly outperforming other sectors of the marketplace through the second half of last year and into early this year. That's normally the case. You do normally see the top end of the blue chip areas leading the growth phase, but they also tend to lead the down phase as well. And it seems to be what's happening here. But also you've got a lot of first home buyers that are active now, and probably that additional level of demand for first home buyers is helping to support activity across that lower end of the market.
Okay, so that's an important point if you're tuning into this, is that make sure you actually drill down into the numbers and look for these nuances, which are going to give you greater interpretation about how you might be able to change or shape or maneuver your tactics around investing in property. And to Tim's point, the lower end of the market where there's probably more activity and greater demand is holding prices firm. So these are the dynamics you need to look at. Let's go down to lockdown Victoria, Melbourne. I think I read the numbers. I think it's doing worse than most, Tim, in terms of capital city markets.
Yeah, a lot worse, unfortunately. So Melbourne was down 1.2% in September, and that was the fifth month of decline. So values started falling in March across Melbourne. And since they started falling back in March, the decline's been about 4.6%. So I guess in the grand scheme of things, considering the context of COVID, that's not that dramatic a fall. We've seen it's on the back of a fairly decent run-up in values as well. On an annual basis, we're still seeing Melbourne home values are up about 6% or 5.9% over the past 12 months. So most homeowners still have a pretty decent level of equity in their property. The market actually reached a new historic high just before COVID. So coming into February, it was a new record high for Melbourne. So it's coming out of the very strong context. But again, when we look at Melbourne's marketplace and drill below the surface, very similar to Sydney, except more amplified. It's that top end of the marketplace that's down more than more affordable properties. Top end, the top quartile's down 7% since March. The lower quartile's down a little bit less than 2%, so down 1.7%. Similar dynamic to Sydney, but also across the suburbs. Look at the broad regions around Melbourne. The areas that seem to be doing it the toughest are your blue chip inner east, your Bayside areas. But once you start getting into your classic first home buyer areas and along, say, the Mornington Peninsula, even getting it out to markets like Geelong and Ballarat and Bendigo, that's where we're seeing much more resilient conditions. Generally, values are still falling, but nowhere near as much as what they have in some of those higher end markets. Also seeing a little bit of weakness across the inner city apartment market, as I mentioned quite early on. I think that's where we're going to see a little bit more pain as we see rental markets causing some distress.
An interesting point I'm thinking about, we're talking about a 0.1% decrease, 0.3% decrease. Like in many ways, it's just a rounding, right? And you only realize that negative growth in property should you sell. So for most people, it doesn't really matter that much. It's just, it's just a number that's out there. For you personally and for the team at CoreLogic, like what moves your needle? Like what do you need to see to go, whoa, quick, everyone stop, let's have a meeting. Property prices have moved by negative 3%. Is that like a big deal for you guys?
It very rarely happens. Property is a pretty gradually moving beast. So generally what would be more alarming is where we see turnover move really sharply. So we saw that in April. In April, we saw nationally the number of home sales fell by a third in a month. That never happens, apart from, say, in January, where there's just seasonality in the turnover readings. So to see turnover in the marketplace fall so sharply, it kind of lines up with all the other COVID graphs where you see just recently GDP fell off a cliff. You saw consumer confidence absolutely tank around the same time in April. You could see consumer spending skyrocketed, then plummeted. So this is just one of the classic examples of COVID, is we're seeing such extreme outliers in some of the numbers compared to the trend. But equally, after that 33% drop in national home sales, we saw activity consistently rebounding through the following months. It was up in May, it was up in June, it was up in July, and then August just started to drift down again. In fact, Melbourne sales were down 20% in August, and will probably fall a bit further through September, considering the lockdown is still in full effect.
Okay, well, let's go south from Victoria. We're going to go a break beforehand, back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Phil Tarrant, host Smart Property Investment Show with Tim Lawless, Head of Research at CoreLogic, Asia Pacific. The Apple Isle doing okay, no doubt. Probably going to be one of the best benefits out of C&G change. People thinking they can find somewhere more affordable. You can get yourself a nice waterfront still on $1 million down there in Hobart, can't you?
Yeah, Hobart's done pretty well, and it has seen a little bit of slippage in prices early in the COVID period, but the last couple of months it's up. In fact, the last 4 months, 3 of those months, we've seen values just edging a little bit higher across Hobart, and they're down about 0.1% from their record highs, right? So they're virtually at record highs at the moment. But as you say, Phil, your money goes a lot further in Hobart. You can buy into some of the most beautiful suburbs in Australia, like Battery Point or Sandy Bay, for selling out of the middle ring suburbs of Melbourne. So I think it's pretty enticing to head down to Hobart. You look at Hobart's trajectory the past, say, 6 or 7 years, and it's been one of the best performing markets, but moving off an extremely low base. And even though values are up substantially over that period, the typical price for a house in Hobart is still under $500,000 as a median. So it's still very attractive in that sense. So we look at Hobart's market, though, even though values have been pretty resilient so far, rental markets are looking pretty fractured across Hobart, particularly in the unit market. So we have seen this the last few years. Hobart stood out as being the tightest rental market of any capital city. But since COVID, we've seen a lot of the Airbnb stock, which has been quite popular down there, has transitioned into the permanent market. And we've seen a reduction in demand for renting as well. So we are seeing now Hobart the worst performing rental market. Unit rents were down a bit more than 5% since the end of March, just to put that into some context.
Well, there's two sides of the room. Have they got the internet down there yet? No, we like Tasmania's. I'd love to have a place. And I once went to King Island. I had a friend that owned property down there, and I thought it was absolutely beautiful. I had a direct flight there. I'd buy there tomorrow, but pretty tough to get there. But anyway, I digress. South Australia, you mentioned earlier on to the top end of the podcast, there's sort of steady as she goes there. What's happening down in Adelaide?
Yeah, it's exactly that. The market in Adelaide historically generally doesn't show the same sort of ebbs and flows as the larger capitals. The August data was absolutely flat, unchanged, so 0% movement over the month. The last 3 months, values are only down 0.1%, so essentially flat. So I guess in many ways, Adelaide's hibernating at the moment in terms of values. We're still seeing activity across the market, a little bit below average, so a little bit less than what it was a year ago, but we're still seeing homes being bought and sold. When you think about some of the drivers of demand across South Australia, they're also quite insulated, not a great deal of exposure to overseas migration. Interstate migration has historically been negative. That's probably stalled out now as well, so maybe that's a good thing. They've done a good job of keeping a lid on the virus, so that's probably another economic advantage they have there as well.
Yeah, and you touched on Perth beforehand. What's the sort of top line numbers in the capital out there now? They've got they're locked up. I think it's going to be the independent state of Western Australia at some point. But how's Perth going? It's good to see they're bouncing back.
I think WA has been pushing for independence from the country for a while, so maybe this will help things
It's
along.
time.
Perth's looking pretty good, actually. Early in the COVID piece, it was actually looking pretty shaky. We're seeing housing values falling about the same pace as what they were in Sydney and Melbourne. So maybe that was demonstrating a bit of fragility in the sense that the market's been through a very long and sustained downturn. We've seen values fall by a bit more than 20% since the middle of 2014. But the last couple of months, we've seen the market stabilize. In fact, last month, the end of August, values were unchanged, and the trajectory is looking pretty clear. I wouldn't be surprised if Perth actually moves back into some level of growth, maybe even September, coming the next couple of months. And it does seem to have a very strong level of stimulus available from the state government. I think finally the state government's doing some very good things around massive spend on transport infrastructure. We've been seeing the private sector seems to be expanding in the mining sector as well. Commodity prices are holding up pretty nicely, which always makes the Perth economy a little bit more attractive as well. Rental markets are also the tightest of any capital cities. So we are seeing rents rising more so than any other capital city, which is pushing yields higher as well. So I think Perth does have a lot going for it. It's also the lowest median house value of any capital city. Amazingly, it's cheaper to buy into Perth than it is to buy into, say, Darwin or Adelaide or Hobart. So pretty amazing how cheap it is for the fourth largest capital city.
And getting into the territories then, ACT and NT, Darwin, always the bridesmaid type of scenario. It's never set the world on fire. Any changes up in Darwin?
Yeah, Darwin is it's a hard market to read because it is quite volatile. It's just such a small region, a very small population of dwellings and low observation numbers. So it tends to move around a bit. The trend, though, is looking pretty positive. The last 3 months, values are up about 1% across Darwin, which is one of the strongest readings of any of the capitals. So if that is a true trend, it's not just volatility, then it probably suggests that Darwin's starting to finally move into recovery. But remember, values in Darwin are about a third lower than what they were back in the middle of 2014. It's had a massive downturn, a very long one and a very large one. Most of that decline in values has been in the unit market, and that sector of Darwin is still looking pretty shaky. In fact, just over the year to date, we've seen Darwin unit values are down a further 3.5%, but house values are up 4.5%. That's over the first 8 months of the year. So it highlights the inner city unit market, which was notoriously oversupplied as Darwin was moving through the peak back in 2014, still has a few issues. But if you buy an investment unit in Darwin and you can get a tenant, the yields are looking pretty strong. The typical gross yield for a Darwin apartment is getting close to 7%. So the trick is finding a tenant in the first place.
Swings around, but have they stopped building apartments up there? Or are they still at it?
No, they have. Absolutely. Yeah. So, supply is pretty much stopped. So I think we're probably getting to a point where it might be worthy of having a look at, what really drives the Darwin market is massive infrastructure projects, and there's not really anything in the wings just yet, it seems. So as soon as there's some further announcements around, further gas exploration or big infrastructure around the gas sector or mining sector or military style infrastructure, that's generally what's going to make that market turn around.
Okay. And the nation's capital, Canberra, it's been doing all right, I hear.
It's a shining beacon.
Yes.
The one market.
It's because no one's lost any jobs down there. They're all public servants, safe as houses. Literally, the property market and also the job market.
Yeah, look at the labour markets. They've held pretty tight across Canberra. Even though prices are pretty expensive, affordability isn't really all that challenging because incomes are generally quite high as well. Hardly any COVID cases, so they've kept the lid on the virus pretty well. So housing prices in Canberra are still at record highs. They haven't fallen at all through the COVID period to date. Rental markets are starting to show a few cracks here and there, but mostly again in apartments. And this is probably another point of paradox is a Canberra apartment market, which is also slightly oversupplied, has been much weaker than houses. So we are seeing a few cracks in the local inner city apartment market as well.
Okay. Well, thanks for the wrap up, Tim. I enjoy that. I'm going to use those numbers. It's good. It's a real learning experience for me because when anyone asks me now, I know the facts. So I'm going to be borrowing a lot of your commentary, no doubt, but I always turn to you for this sort of stuff. I just want to touch on, and before we close out the podcast, Tim, the dichotomy between property market growth, property market movements, the thoughts or perceptions towards it versus sort of consumer sentiment. It's intrinsically linked with what people think at any given time. And as we've seen through COVID, consumer sentiment just floored and now it's slowly bouncing back. It's different at different parts of the nation right now. How much is the property market driven by consumer sentiment, and how can you make sure that you can make informed decisions because of those dynamics?
Yeah, it's a really important component. So if you look at the correlation between market activity, so housing sales, so turnover, and consumer sentiments, the correlation is extremely strong. It's not perfect, but it's up around the 80% mark. And it really highlights that buying and selling a home is one of the highest commitment decisions anybody's going to make. So it makes sense that if you're a little bit unsure about your job or your household balance sheet or the domestic economy or even the global economy, it's going to make buying or selling a home or making any sort of really high commitment decision much harder. So going back to the numbers, there's a couple of different mainstream measures of consumer sentiment. You've got the monthly reading that comes from Westpac and the Melbourne Institute, and you've got the weekly reading from ANZ and Roy Morgan. And both of those trends are showing exactly the same thing. As you say, Phil, sentiment absolutely plummeted through late March and April. It got down to levels last seen in the last recession in the early 1990s. And then it bounced back really quickly. It didn't quite recover. So that bounce back in sentiment also was in parallel with a bounce back in market activity and some stabilization in housing values, or at least at the rate of decline. But more recently, we've seen what's happening in Victoria having a really detrimental effect on consumer sentiment all around the country, not just in Victoria. In fact, on the Westpac monthly reading for August, we saw New South Wales sentiment fell further than what it did in Victoria. So it really highlights that consumers are a little bit fragile at the moment, and everybody's probably wondering, is what's happening in Melbourne and Victoria potentially going to happen in my community? And what if it happens? What are we going to do, right? Could I lose my job? Could I not be able to pay my mortgage? We'll have to start stockpiling again, that sort of stuff. So I think going forward, sentiment's probably going to remain quite fickle, and it will probably turn on a dime based on outcomes with the virus. So that's why it's so important that we all do the right thing and try to keep this virus in check. But what's happening in Victoria, I think, is the best case example here of what happens through a lockdown. Again, we've seen the Victorian economy is just stalled. We've seen home sales have fallen really sharply through August, and they probably will again in September. Consumer activity is right down. The number of auctions coming up this weekend are going to be less than 50. So from previous to the previous lockdown, it was up around 500 to 600 a week. So the market is really, fickle when it comes to the virus and what it means for buying and selling decisions.
So moving forward then, and to your point earlier, data as a great way to measure and give insights into what's happened with you to looking how it might shape the future with some smart mathematical models, which you guys have got plenty of, I know at CoreLogic. It's hard to look too far out in the horizon. What are we talking about, Tim, in a year's time? Are we going to be talking about doom and gloom in property, markets falling off cliffs, Australians losing all their wealth? Or do you think it's going to be this same narrative of stability with some fluctuations at different types of the market?
I think within a year, hopefully either there's a vaccine or we've got to some level of new normality, and that means the market's moving through some recovery. But I think, casting your mind out a year is really hard right now. Even just getting out, say, the next 6 months is going to be quite dynamic. Even at the end of this month, we're moving to a period where a lot of the fiscal support starts to taper from about 18 billion spend a month down to 3 billion. We've got the 6-month check-ins for home loans happening, and then the expiry at the end of March next year. So I think the next 6 months probably will be characterized by a rise in the number of urgent or distressed sales coming through the marketplace. That could place some additional downwards pressure on housing prices. So maybe this stability, this resilience or insulation we've seen is a big part of that, is the amount of stimulus that's available and the repayment holidays that people have been able to take. That all starts to change pretty soon. So I think we need to see how the market reacts to that. And from there, we'll start to get a feel for how long the downturn is going to persist. My gut feel is this is going to be quite a gradual but prolonged period of weakness in the market. I don't think the housing values are going to fall off a cliff by any means, but I think they probably will continue to either stabilize or drift lower for some time, which means the buying opportunities are probably pretty decent, but I wouldn't have any expectations of rapid price growth just yet. But hopefully coming into, say, the next 12 months or 12 months from now, that's where we start to see everybody becoming a little bit more accepting of a new normal.
Mm. And for CoreLogic, has it changed the way people are consuming property data? Are people still buying reports? Real estate agents are as active as ever. No doubt they're sort of drawing all the insights out of your organisation. What's happening there at a corporate level?
Yeah, there's a whole bunch of different facets of the clients we work with. So from a banking and finance perspective, for example, there's a lot of focus now on risk minimization and risk mitigation, for example. What are some of the areas that could be harder hit by distressed properties? This goes back to our conversation around inner city apartment markets, for example. From a real estate perspective, of course, they're dealing with a very volatile number of listings coming in the market. Listing numbers are still way lower than what they normally would be for this time of the year. And normally in the first week of spring, we start to see a pretty decent ramp up in the number of listings coming on the market. It's the opposite at the moment. New listings are actually either steady to falling at the moment. So real estate agents are really just buckling down. It's become a game of market share, of course. So attracting the listing across a smaller pie is really the name of the game to ensure you can make the sale. But those people that get the listing, properties are still selling. You can see that the rate of absorption has been really strong. So there's more properties that are being purchased than what's being added to the market. That's probably another reason why housing values haven't fallen by very much at all. It's just there's not much supply or not much available supply around at all.
Mm. Yeah, well, at a on the ground level, I no doubt Tom Panos. I was chatting with him today, and he was raving about his auction clearance results. He's sort of 11 out of 12 the last 2 weekends. He's going, markets are doing pretty well. If it's there for sale, it's selling. So, low interest rates help a lot. And if you've got stability in your job, it's probably not a bad time to buy, whether it's owner-occupied or a property investment. But Tim, thanks for your time today. We should do this more often. I always sort of turn to you for this sort of information, and CoreLogic's supported Australian investors for many years. So keep up the good work. Anything new coming from you guys? You've always got something in the wings that your people are sort of brewing up. Is there any new reports, any new insights coming down line?
Yeah, our next report off the cab rank is going to be a really detailed view on rental markets, including things like vacancy rates and rental listings. We're starting to do a lot more work now on really micro level listing numbers for both for sale and for rents, which is driving those vacancy rate indicators as well. So that'll be an interesting one to watch for. It shows that, broadly across the country, rental markets are actually tightening. There's fewer rental listings out there now than there were, say, the last couple of months. But it's become really fragmented. Your inner city market's seeing a doubling of rental listings, whereas many of your middle ring and outer ring detached housing markets have seen fewer rentals available. So pretty interesting to see how it's playing out.
Well, let's get you in to have a chat about it, because it is a tale of two cities. And I think what happens is that everyone does this catch-all of, rents are really distressed at the moment and vacancy rates are through the roof, when that isn't necessarily the story. So we'll get into that. That's Tim Lawless, Head of Research, CoreLogic, Asia Pacific. Thanks, Tim. I'll chat to you soon, mate.
Good to be on the show, Phil. Thanks.
Nice. Remember to check out smartpropertyinvestment.com.au. If you're not yet subscribing to our daily morning newsletter, so the first know what's happening in property and property data right across the nation, smartpropertyinvestment.com.au/subscribe. Social media, you can find us at Smart Property HQ. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.